Assalamualaikum. Hello guys, welcome to my YouTube channel. In today's video, I'm going to tell you about what is cryptocurrency ETF, exchange traded fund, ETF versus futures, and what are the advantages and disadvantages of using ETF. But first, if you not subscribe the channel, kindly hit the subscribe button. So let's start the video. A cryptocurrency exchange traded fund is a fund consisting of cryptocurrencies. While most ETFs track on index or a basket of assets, a cryptocurrency ETF tracks the price of one or more digital tokens. Based on investor sales or purchases, the share price of cryptocurrency ETFs fluctuates on a daily basis. Just like common stocks, they are also traded on a daily basis. So how does a cryptocurrency ETF work? Cryptocurrency ETFs provide several benefits to investors, such as significantly lower cryptocurrency ownership costs and outsourcing of the steep learning curve required to trade cryptocurrencies. There are two kinds of cryptocurrency ETFs. The first type is backed by physical cryptocurrencies. The investment firm managing the fund makes purchases of cryptocurrencies and ownership of the coins is represented as shares. When purchasing shares in the ETF, investors will indirectly own cryptocurrencies. Thus, owners can gain exposure to cryptocurrencies without the accompanying expense and risk of owning them outright. Second type is a synthetic variant that tracks cryptocurrency derivatives like futures contracts and cryptocurrency exchange traded funds. Here at Gate.io, cryptocurrency ETFs use perpetual futures contracts. Now you might be thinking, well, if the ETF just owns futures, why don't I just trade futures directly? So what's the difference between ETF and futures? The difference is how the leverage is being used. ETF buys futures contracts, but it rebalances how many futures it owns to keep the same leverage ratio as its advertised price. This is the advertised price of BTS 5 times short, and the current price is 1.0516. You can see there is 29% change in 24 hours, and high is 1.18 and low is 0.8. On Gate.io there are 268 ETFs available to trade. ETF owns future contracts and rebalances how many contracts the ETF has to maintain the same leverage ratio as its advertised price. For example, if Bitcoin rises in price, then the Gate management of a 3x long Bitcoin ETF may have to buy some more Bitcoin futures to keep the same 3x ratio. Or if Bitcoin drops in price, the ETF may have to liquidate some futures contract to maintain the same investment to leverage ratio. This means you never get liquidated from your position, no matter how much it moves against you. You could lose a large percentage of assets, but never 100%, even if it's a short cryptocurrency ETF. See, this is in sharp contrast to how it would be if you were shorting of futures or if you were shorting a crypto on a margin in the spot markets. In both those situations, you would have to maintain a certain amount of collateral to maintain the position. With the ETFs, they rebalance, so it reduces your position as it moves against you, and you don't have to constantly monitor it to make sure that you have enough collateral. This allows you to take a large amount of leverage without having great timing or having to constantly monitor your positions. So ETF rebalances at the same time every day. This rebalancing has the advantage of making sure that you are never liquidated out of a position, no matter how much it moves against you. The disadvantage of rebalancing is that a temporary price movement against you could cause a permanent loss in equity even if the price rebounds back again after. Consider a long 3x Bitcoin ETF that rapidly drops in price at the end of the day. Rebalancing software might liquidate some long Bitcoin futures contracts to rebalance and avoid liquidation. Then suddenly the Bitcoin price rebounds and goes back to its original position. The owner of this ETF would not recoup their full loss because the ETF now has a smaller futures position on the way back up. than it originally did when it fell. ETF trading is lot more easier for new traders. With futures contract, you have to do math to make sure that you can withstand the amount of risk that you are willing to take of it moving against you without being liquidated. While as with the ETF, it does the math for you during its rebalancing. In summary, ETFs are good for newer traders because of their initiative pricing, and in addition help more advanced traders in taking on large leverage without having perfect timing, because you don't have to constantly monitor your risk when using leverage. However, ETFs are not so good for a range bound environment that's chopping back and forth like the market nowadays, because it will rebalance based on the time of the day, not strategically based on price. If price trends in your favor, then you will feast on huge reward far more than if you took a regular futures contract, because it's adding to your position as it's moving in your favor. But even if the future moves against you, as long as it trends in that direction, you will be reducing your position by the ETF removing futures contract, which never takes you out of the game. So this was our today's video about the ETF. My next video will be about the event that is currently running on the gate.io. I will discuss about that, how you can take part into that event. So kindly hit the subscribe button for more future updates. Thanks.